Good morning and welcome back to Capital Sound. We're waking up to a very specific mix. Overnight reports of a ceasefire proposal pushed oil lower, and that immediately lifted risk sentiment in futures. It is a classic relief rally setup, but it is resting on fragile headlines from the Middle East, and that matters for inflation rates. And the sectors that have been leading, today we're going to parse what that overnight shift could mean for the open and whether it fades or sticks. I am joined by Rajiv Kapoor, who always brings an emerging markets lens and a steady dose of optimism tempered with discipline. Rajiv, thanks for being here early.
Morning, Mandy. This is the kind of headline-driven tape where a calm read really helps. Let's dig in.
Let's start with the market snapshot. Futures are leaning higher after that ceasefire chatter, but it feels like a cautious bid rather than full throttle risk. On the VIX is around 14, which tells you fear isn't dominant, yet it is not sleepy. Yields moved modestly higher into the morning, and that keeps duration. Sensitive areas on alert. In recent sessions, energy and commodities have been the relative winners, while some growth names have lagged. Breadth hasn't been awful, but it has been uneven. You can see rotation rather than a broad sweep. Rajiv, does that setup point to a stable opening, or do you expect more chop?
I'd frame it as a cautiously constructive open, with a high probability of intraday reversals. The overnight tone is improved because oil backing off takes immediate pressure off inflation expectations, and that helps the broader market mood. But the relief is built on headlines that can flip quickly, so I wouldn't assume a straight line. Also, rates are still elevated relative to where equities are happiest, which means any morning strength could face pushback if bond yields tick up. I am optimistic on the base case for a steady open, assuming rates don't spike. If that changes, so does the tone.
You are saying the market might come in stronger, but the foundation is still headline risk and rate sensitivity. That is a helpful framing. Let's go deeper on story one, the Middle East conflict and the shockwaves into oil, inflation, and sentiment. Overnight, we had reports that a ceasefire framework is being floated. Oil prices dipped. Stock futures climbed. At the same time, we've got warnings that any disruption of the Strait of Hormuz would be catastrophic for the global economy. So the question for today is, do traders lean into the relief or treat it as a temporary bounce?
The immediate effect of that headline is pretty mechanical. Lower oil means less near-term inflation stress, and that is supportive for risk assets. But the geopolitical situation is still a major variable. The economy doesn't need a major energy shock right now. It needs stability, so the market is likely to trade that tension all day. If the ceasefire chatter gains credibility, cyclical sectors could get a lift because investors will feel better about margins and consumer spending. If the headlines deteriorate, energy and defense could see a defensive rotation, while consumer and transport names could feel pressure.
Let's unpack the sector angles on a day when oil drops. Do you expect airlines and transports to benefit, or is the market too nervous to reward them?
It depends on the durability of the move. Airlines and transport are very sensitive to fuel costs, and a softer oil tape gives traders permission to reassess that pressure. If oil keeps drifting down into the open and stays there, you could see a relief bid. But I'd caution, the one thing that would challenge this is a sudden reversal in crude. That is still very possible given the geopolitical backdrop. So today's trade for these sectors might be fast and tactical rather than a durable repricing.
That makes sense. You mentioned consumer spending. If energy costs cool, the consumer gets a bit of breathing room. But the news flow also says businesses are seeing higher prices and fewer orders. That is a mixed signal. How do you reconcile those?
I see it as a tug of war. Lower energy costs are a near-term positive for consumers, while softer demand indicators are a warning sign. It is not a recession call from me, but it is a reason to stay selective. For example, defensive consumer staples may hold up better in a slower demand environment, whereas discretionary names need a clear signal that the consumer is resilient. The base case for today, a relief tone early, but traders will be watching for any macro data or comments that confirm whether demand is holding.
So in plain terms, the day could start with a sigh of relief, but it is not a green light across the board. Let's connect this to your emerging markets lens. How do these energy headlines play into India's setup?
India is a large energy importer, so softer oil is directly positive for the macro. It eases the inflation burden and can support the currency. That is a short-term tailwind. At the same time, global risk sentiment is still the tide that lifts or lowers M allocations. The base case for India remains strong because of domestic growth and reforms, but I could be wrong if the conflict escalates and triggers a sustained spike in energy costs. Today's trade may highlight that sensitivity.
That is a nice bridge into story 2, the bond market and rates. We have a warning that long-end yields are pressing higher and a report about a shaky treasury auction that hinted at investor anxiety. Meanwhile, Japan's bond market is under pressure and the yen is hovering near 160. That is a lot of cross currents for global capital. Rajiv, how does this influence today's session?
The bond market is the undercurrent here. If yields climb, they compress equity valuations, especially for longer duration growth stocks. Investors aren't paying as much for future earnings when bond yields are higher. That can hurt big tech and other rate-sensitive sectors today. If yields stabilize or ease, you could see growth participate in the relief move, but if yields push higher, you may see rotation into value or defensive names. The auction jitters matter because they hint at investor demand for debt, and that has ripple effects for all risk assets.
You are telling me to watch yields as much as headlines, but for listeners, rates can feel abstract. What should they look for today that signals trouble?
A few signals. If yields jump early and stay elevated while stocks are trying to rally, that is a warning that the bond market isn't buying the relief story. Also, watch financials. Banks often benefit from higher rates. But if rates rise for the wrong reasons, like risk premium, the market can be nervous. And keep an eye on the dollar. A strong dollar can tighten financial conditions and weigh on emerging markets.
Let's stick with the Japan point for a moment. The yen near 160 suggests pressure. Does that spill into global equity sentiment today?
It can, because it hints at capital flows and policy uncertainty. A weak yen can support Japanese exporters, but it also suggests volatility in global currency markets. That volatility can make investors more cautious in equities. However, if the yen stabilizes and Japanese yields stop rising, global investors may breathe a little easier. The base case is still manageable, but the challenge would be if currency weakness accelerates and forces more aggressive policy moves.
That is another hinge point. So today's session could be about whether bond yields cooperate with the relief mood from energy. This is a lot for traders to process in one day. Let me check your view on growth versus value. Are we looking at a tug of war there?
I'd say yes. With yields elevated, value and dividend-oriented sectors often look more attractive, but if yields ease and oil retreats, growth could catch a bid. The session may feature quick rotation, with money moving from one part of the market to another. The approach I'd take is to watch which group leads into midday. That can tell you whether the relief tone has staying power.
All right, let's quickly run through the remaining stories and tie them into sectors. We've got headlines about inflation ticking up, growth slowing, and a weaker PMI flash. There is also a note that commodities remain the strongest performer year to date among major asset classes. Another report suggests a pause in strikes lifted markets. But the calm looks fragile taken together. How do you see the rotation today?
The mix suggests a balanced but cautious market. Commodities staying strong tells you that inflation risks aren't gone. That can keep energy, materials, and certain industrial names in focus. The softer PMI and growth signals tell you to respect defensives, healthcare, staples, and utilities. But the cease-fire headline tilts sentiment toward a brief risk-on phase, so you might see a morning bid in cyclicals like financials and consumer discretionary. The key is whether that bid persists once the bond market opens in full and yields settle.
So we're watching three things at once: energy prices, yields, and the tone of economic data. That is helpful. Let's move into the watch list and opportunities for today with the usual reminder that we're not giving advice, just highlighting what is likely to be active. Rajiv, what is on your radar?
I'll break it into three buckets. First, energy and refiners. If crude continues to soften, refiners may benefit from improved input costs, while upstream producers might ease. Second, rate-sensitive sectors like REITs and utilities, they can be volatile today because of the yield backdrop. Third, global cyclicals, especially industrials and select financials, could see early strength if the risk mood holds. On the emerging market side, I'll be watching India's financials and consumer names as a barometer for how investors are thinking about domestic demand. The setup is positive, but the one thing that would challenge this is if the dollar spikes and global risk appetite deteriorates.
Let me push back slightly. If demand data is softening, why would cyclicals gain much traction, even with a headline relief rally?
That is a fair challenge. I am not saying cyclicals are a slam dunk. It is more about how traders react to a shift in perceived risk. If the market senses that the worst case geopolitical scenario is off the table, even temporarily, it tends to rotate into economically sensitive names. That doesn't mean the fundamentals are suddenly robust. It is more about a recalibration of near-term fear. I'd still be selective and mindful of how durable the move is.
Good clarification for listeners tracking individual stocks. We can't name specific tickers today, but categories matter: airlines and transport on the oil move, semiconductor stocks if rates stabilize, retail if the consumer feels any relief, and the banks given the rate moves. Rajiv, any other angles?
I'd add defense contractors and cybersecurity to the watch list because they tend to be active in periods of geopolitical tension, and I'd keep an eye on high-quality dividend names. When markets are jittery, investors gravitate to steady cash flows. That said, dividend-heavy stocks can still face pressure if yields continue climbing. So the rate path matters. I am optimistic about the base case for a steadier session, but I could be wrong if bond yields jump higher after the open.
That is your third risk check, and it is well placed. Let me summarize today's picture in a fresh way. We're looking at a morning that wants to be positive because oil is down and futures are up, but the confidence is still thin. The bond market is the gatekeeper. If yields behave, the relief rally can breathe. If not, we could see quick rotation and choppiness, and the geopolitical headlines remain the wild card.
That is exactly how I see it. I'll add one more nuance for listeners. The intraday path could be more important than the open. If the market starts strong but fades as yields rise, that is a signal that investors are still defensive. If we see gains hold through midday, that could tell you the relief theme has legs, at least for a day. It is a session where patience and observation matter.
That is a good reminder that today's story may be written in chapters. Before we close, I want to ask, how does the India growth story fit into a day like this? You are known for being optimistic, but disciplined. What is your base case for today's market mood on that front?
India's base case remains attractive: strong domestic demand, improving corporate efficiency, and continued investment momentum that can act as a stabilizer on days when global headlines are loud. If global risk sentiment improves, India tends to benefit from inflows, but I'll be candid. If we see a broader risk-off move triggered by rates or geopolitics, India can't fully escape that. It is a solid foundation with upside, but it is not insulated. Today, I'll watch how global investors react to the energy headlines to gauge whether that foundation gets a tailwind or headwind.
That is balanced, and it is helpful for listeners who want a grounded outlook rather than a cheerleading pitch. Rajiv, any final thought for the morning?
Keep your eyes on the bond market and oil. Those two will likely set the tone, and everything else will follow their lead. I am hopeful for a stable session, but discipline matters because headline risk can turn quickly.
That is a solid way to frame it. Thanks for joining us early, Rajiv.
Always a pleasure. Mandy, good luck to everyone navigating the day.
And thanks to all of you for listening to Capital Sound. We'll be back tomorrow to make sense of whatever the markets throw at us next. Have a steady and thoughtful trading day, and goodbye for now. End of script.